The second thing that you really need to focus on are what kind of assets do you have overseas? So if you have a pooled asset, something like a mutual fund or an ETF exchange traded fund, those are what we call pooled assets. Now that would be viewed in the United States as what's called a passive foreign investment corporation. So a good term to remember is PFIC. So if you have overseas investments, you need to understand what the consequences would be of holding those investments and what it would mean for US taxation. So the reason they get into it is because most pooled assets overseas do not report income information back to the United States. So the United States taxation system takes a very dark view on it, meaning that they're going to assume that there's more income being reported than what you're aware of. So there are reporting requirements that people need to be aware of, and if you don't report it correctly, then you could be subject to a large tax and penalties. Those I would argue are the two main things that people would need to speak to. And then there are obviously a number of other planning issues that Paul and I have, can address, that people need to be thinking about whenever they come to the United States. So estate planning, which is something Paul's very good at.
And even on the income tax side, if you have in your home country, you have an operating business, you own a factory, you own something there that is an operating entity. There are ways that we can actually put something between the United States and that entity where we can minimize the tax impact to you personally. If you're not living off the money that's being generated, if the money is just staying in the business, or you have other assets you can use, we can put it into a type of a corporation, which will shield it from U.S. taxes, and then you'll only be liable in taxes of money that you take out of that corporation. So if there, like Jason touched on the investments, which is a big issue, and then there are workarounds for particular types of business that people may have.
And that Paul makes a good point, Peter, which is it goes to the very first thing that you said. When you're thinking about coming to the United States, the first thing you need to start doing is planning what are the impacts going to be on your current asset and income situation. And then the second piece is what will be your income and asset situation once you get to the United States. So planning is absolutely the number one thing that we recommend people think about when they're considering this process.
I couldn't agree more, right? And I think that the best ways to really is to maybe break these down into some separate type of mindsets is your taxation and making sure that everyone wants to make sure that you're doing right, that you're coming and you're being a good citizen and that you're paying your part. But what you don't want to do is put yourself in way of obligations that have no bearing on your current status, your current situation, that could very easily be more adequately planned for as you're moving forward. So maybe if you guys want to talk a little bit more about maybe some of the types of income or the types of assets they might be receiving that they might be subject to taxation that they might not be aware of, and then maybe some of the ways that they could look, obviously in a broad sense, protect themselves against maybe some of these obligations that are unnecessary to be putting themselves subject to.
So sure, and there are some that people get caught up in things very innocently often. We had a client who received a small pension in their home country, and it was less than $20,000 a year. And it was below the threshold that required reporting in the home country, that required taxation in the home country. So he figured he didn't pay taxes there. He didn't have to pay taxes here. Never told anybody about it. Lived here for 10, 12 years. And all of a sudden mentioned it in passing. Oh, I've got this small, $20,000 pension. And like, wait, we've done your taxes for a decade and never picked that up. You never told us about that before. And so it was something, he wasn't trying to avoid taxes on it. And he was actually in a country that has a tax treaty where he wouldn't have paid extra taxes. He would have paid more in here, but he got to turn it back in the home country. But it was just, you have to realize there are things that you don't necessarily think about because it may not be taxed in your home country that is in fact taxed here.
That's a really good point, Paul. The number one thing that we find from clients is it's not so much that they are looking to not share information, they just don't think about it. A great example is we had a client from India who had a number of properties that were owned by his mother, but he was set to inherit them upon her passing. Well, this was never disclosed to anybody because he didn't think it was a big deal. And when she passes, then the assets would just go into his name. But these were investment properties, and these investment properties were going to yield income. And if that income is not properly reported in the United States, then you can have significant penalties and fines. So it's really very important that when you're speaking to any professional when you come here, no matter what the small detail is, it's very important that you share it with with your advisors when they get to the United States. The United States takes a very, very broad view of what needs to be reported. Now, that doesn't mean that you can't take steps to minimize your taxation or other steps like that, but you still are required to report the information. And that's the most important piece.